Hello, I'm Simon Potter, Chief Executive of Bahamas Petroleum Company, or BPC. I'm joined today by Eitan Ulio, our company's Commercial Director, and we're here to provide information to shareholders about our recently announced proposed merger with Columbus Energy Resources. Please pay attention to the contents of this disclaimer. So let's jump right in then. The rationale for this merger. Perhaps the most frequent question we've received from our shareholders: why combine with the Columbus? Currently, we believe the international hydrocarbons industry is in a state of flux, where pure exploration plays with a single, albeit huge, potential resource base, especially in frontier basins, are increasingly less able to deliver a transformational shift in shareholder value within a reasonable investment timeframe. So it is in this context that the transaction and the proposed combination of BPC and Columbus assets needs to be appreciated. We will be creating a full cycle Caribbean region and Atlantic margin focused exploration and production company with multiple projects and growth potential. Let me elaborate further on this. In BPC, as shareholders will only be too aware, we already have a drill-ready project in the Bahamas. We got to within 3 weeks of spudding the Perseverance 1 well prior to the onset of COVID-19, which meant ultimately we had no choice but to delay drilling until the 2020 hurricane season abates. We have also recently been awarded a license offshore Uruguay, but the risk-reward profile of these two considerable assets are similar, albeit different in timescale and play type. So now compare that to the addition of the Columbus assets, which will create a broader portfolio with much more balance. A merger of assets that are complementary, being at various stages of maturity. This is what we mean by full cycle, a range of assets that span exploration, appraisal, development, and production. Then within this portfolio approach, the assets themselves have diversity, onshore, offshore, different geography, different jurisdictions, and indeed, again, different play types. Specifically, the enlarged portfolio will include within it production income in Trinidad, which we believe can be grown organically at low cost given the shallow depths of the reservoir, not only through mechanical intervention of workovers and reactivations, but also through enhanced recovery techniques. Appraisal projects, that means extensions to known or existing fields that can be undertaken at low risk, and low-cost new development options in both Trinidad and Suriname. Then, of course, over and above all of this, we will still retain all of the potential high-impact, high-value exploration upside from the planned drilling in the Bahamas and in the longer term in Uruguay.
If I can jump in here, Simon, it's Eitan, the Commercial Director speaking, and to emphasize the point, in the rapidly evolving international oil industry, it seems to us that having a portfolio has become more and more important in that it brings with it a number of advantages that BPC would not, at least in the near to medium term, be able to enjoy on its own. These are basically production and greater access to capital. In terms of production, in the current environment, quite simply cash is king, and being able to generate cash from production is incredibly important, especially if you believe, as we do, that production and hence cash generation can be grown organically and at low cost and will rise if oil prices recover from their near historic lows. And in terms of greater access to capital, this is very important. The creation of a broader full cycle exploration production company is more likely, in our view, to attract further and greater amounts of capital from institutional and long-term sources of capital. We'll have a bigger market cap, increased liquidity, and more importantly, it enables spreading of the risk. Individual retail shareholders might be quite content with a company that will live and die on a single well outcome, but larger sophisticated investors in the sector, pension funds, private equity firms, institutions, the people who can write large individual checks and fund not just one well but several, they want diversity and the assurance of knowing that they do not risk total capital loss on a single well outcome.
We appreciate that BPC shareholders have been patient over the years whilst we brought the Bahamas opportunity to fruition. But within this enlarged portfolio, we'll now have multiple near-term value catalysts over the next 18 months, including between now and when we commence drilling in the Bahamas later this year. There's also nothing to stop us further enlarging the portfolio over time, and we believe there are a range of further consolidation options close to the existing fields. This would enable us to create a greater range of cost synergies and with a lean incentivized management team. So what do the assets of Columbus bring to us at BPC? Well, there's an old adage in the industry, where do you find oil? In an oil field, which in the case of Trinidad is very apt indeed. In the Trinidadian assets held by Columbus, we have a great mix of fields. A number are already in production and have been for many years. Some of these offer opportunities for relatively straightforward application of near-term production enhancement techniques, whilst others are discovered and await appraisal, and over and above this there's a range of new development options. In the Southwest Peninsula, where Columbus has a dominant acreage position, we will realise a considerable exploration inventory of prospects. Currently in production are 5 low-cost onshore fields generating current and immediate revenue that cover the costs of operation. In the immediate short term, we believe this production can be increased by enhanced recovery techniques such as water and CO2 injection. Recent discoveries in the Southwest Peninsula area offer near-term appraisal and development options that could lead to further material incremental production. And given the proximity to existing infrastructure, in the event of success from within the broad prospect inventory, resources can be converted to reserves and commercialized relatively swiftly. We will also inherit a full Trinidadian team of in-country management and operations staff that assure business continuity and continued delivery, albeit in the future under BPC executive management guidance and leadership. In Suriname, in the Vegnaze PSC, there is the opportunity for existing infrastructure-led low-cost development at a very modest cost, where production can be brought on stream relatively quickly to generate further revenues. This is a business model and technical opportunity that I'm personally familiar with, having previously managed exactly the same type of assets in Suriname when I was at Hardman Resources. In short, given the expertise and experience of the BPC management team, I'm confident that we will be able to manage and drive production growth, thus cash generation, and further the exploration agenda across the whole Columbus portfolio. On this slide, you will see a map depicting the location and range of the Columbus assets in Trinidad. Notwithstanding the COVID lockdown restrictions, let me assure all shareholders a considerable and extensive grounds-up view was taken of these properties during extensive technical and commercial due diligence, and we feel we have a great understanding of the asset base and thus underlying potential. To the right, to the east, are the existing Goudron and close by the Trinity Innis fields, both of which offer existing production. This is where near-term water injection and CO2 injectivity projects offer considerable opportunities to further increase oil recovery at modest cost. The Goudron field is a case in point where we feel BPC management experience can extract value from mature assets. Where do you find oil? It's in an oil field. Well, in Goudron, there are over 200 wells, of which currently 50 to 60 are in production. This is exactly the kind of mature field option offering considerable nodes of access to generate further incremental production. It's hard work, but rigorous application of technical processes can see immediate results. Coming more to the center of the map is Corey Moruga. This offers a development opportunity, as does farther west the South Erin field, both of which can be brought into production in a relatively quick time frame. Finally, to the left, in the Southwest Peninsula of the country, Columbus has that dominant exploration position. Most recently, there has been considerable encouragement with the announcement of the Saffron discovery, which offers immediate appraisal and development opportunities. The due diligence also gave us a bit of a pleasant surprise when we identified a much more considerable exploration portfolio than we had anticipated. Again, close to existing infrastructure and capable of development relatively swiftly in a short cycle time and therefore at relatively modest cost. So in summary, of the enlarged portfolio, BPC believes that given the management team expertise, Production income could be grown organically at low cost from shallow reservoirs. Near-term low-cost appraisal undertaken to expand existing fields and new discoveries, and options for new field development matured. Thus, in short order, the reserves base of the company can be considerably enhanced.
Turning then to page 5, and in a way placing all of what Simon has just said onto a single map, you get to see visually what we are talking about. BPC, in combination with Columbus, represents a balanced portfolio of complementary assets poised for delivery of production, appraisal upside and growth. As you can see on this map, the portfolio spans 4 jurisdictions: Bahamas, Trinidad, Suriname and Uruguay. Within that, we will have multiple play types, both offshore and onshore. There is immediate income from production, immediate opportunity to grow that income, and the ability to grow that even further through near-term appraisal and development. And shareholders will still continue to have exposure to the big exploration upside offered by drilling in the Bahamas in late 2020, early 2021, as well as longer term, the prospect of repeating the Bahamas experience in Uruguay. So a full cycle exploration and production company with a focus on the Caribbean and Atlantic margin. Continuing then on to slide 6, and again summarizing much of what Simon has said before. With a portfolio, we will have multiple projects at different stages of maturity, so shareholders will be able to see activity across the portfolio. In the Bahamas, drilling of Perseverance 1, in Trinidad, where we'll be working hard to increase production and where there will be a second saffron well which, if it's a success as we hope, will pave the way for a development, and in Suriname, where some very low-cost test wells will, if successful, lead to a rapid development commercialization there, and also in Uruguay, where we'll begin the first steps of geological and technical evaluation in the license's initial 4-year term. And that is all laid out on the chart you can see in front of you. Now, an obvious question shareholders will ask: how do you expect to pay for all this? And really, there are 4 parts to this response. First, shareholders should understand that offshore drilling is by far more expensive and more capital intensive than activities onshore. So almost by definition, the capital required to progress and unlock value across the Columbus portfolio is far less than the capital needed for even a single exploration well like Perseverance 1. Second, while Perseverance 1 must be drilled within a certain time frame to remain in compliance with license obligations, and which means that the capital to be used on this activity is by and large no longer discretionary, there are very few overarching timing imperatives across the Columbus portfolio. So this means that the need for capital is discretionary and we're in control. We can elect to spend money when and how it best fits. And having this level of control, the ability to make rational capital allocation decisions, is a core benefit of having a portfolio and a core way in which company management can better manage the overall delivery for shareholders. Third, and as we've already detailed, a central part of the thesis in merging with Columbus is the notion that we can grow production and hence see income rise over time, both as production expands and as oil prices rise. Surplus cash can therefore be redeployed internally, or in other words, we're hoping that to some extent the activities will become self-funding. Equally, we can drive operating cost efficiencies and synergies, and again, this ensures more capital is freed up and available for deployment into activities that have the prospect of generating return. And fourth, it's a tried and true path in the oil industry to find partners as projects mature, and in so doing shift some of the funding obligation onto those partners over time. Now, BPC shareholders are well aware of this, in that we've been working on a farm-in consistently for several years, and it remains very much on the agenda to find a farm-in partner for our licenses in the Bahamas, either now or after Perseverance 1 is drilled. But the same holds true for Columbus's assets, and indeed, Columbus themselves have already put in place various farm-in type arrangements that if we choose to continue, we could, and which would defray a big chunk of the capital cost. So in short, when it comes to capital, the incremental need being imposed on the business by the Columbus portfolio is quite modest when compared to Perseverance One, and we have the benefit of a huge amount of control, so we can manage and monitor capital outflows closely. In a broader context, I would also add that we as a company and management team are very focused on conserving cash and wisely deploying it. So for example, as was detailed in the announcement of the merger, everything to the greatest extent possible has been structured on a share basis. The majority of costs and settlements consequent on the transaction are being paid in equity, not cash, and this includes, for example, refinancing Columbus's existing debt facility, which will be paid out in equity as part of the transaction, achieving a double aim of not using cash as well as enabling the merged entity to be debt-free. And more generally, I would just finish by pointing out that BPC has a clearly defined funding strategy in place. We presently have more than $11 million cash at bank, and we have a number of other funding sources already established that our shareholders should be well familiar with. And if all of these funding sources were fully available and fully drawn, would see access to more than enough capital than we presently anticipate needing. As we've repeated in many forums many times, our approach to our funding strategy is not scattergun. It's measured, consistent, and has been designed to ensure that we have the funding required for Perseverance One and now the broader portfolio available as and when required and on the best possible terms. And I guess finally, I will repeat what we said earlier. We believe the combination with Columbus will significantly improve the combined entity's access to capital. So in some ways, this merger is not only benign insofar as the Bahamas is concerned, but is in fact a great way of better assuring the ability to source the capital and therefore drill in the Bahamas by providing this greater access to new differentiated pools of finance.
Thus to another very often asked question: does the merger with Columbus have any impact on the drilling of Perseverance One in the Bahamas? Well, put simply, it doesn't. The same Perseverance One drill plan that existed a month ago exists intact today. Indeed, we've taken the time to further peer review the plan and it remains intact. It is robust. The drilling of the well remains the absolute priority of BPC's management and the dedicated drilling team assembled, and is on track to be commenced between the end of 2020 and early 2021, the earliest opportunity after the 2020 hurricane season abates. So let me be absolutely clear. A rig is unconditionally contracted. Globally renowned service companies are engaged. Long lead items, critical path items have been purchased and are warehoused. A high quality drilling team has been assembled. Environmental authorization from the Bahamian authorities has been received, and a funding strategy is in place. As far as Perseverance One is concerned, and as far as BPC management focus is concerned, nothing has changed. The schedule for drilling is to commence either in early 2020 or early 2021. The target has a P50 of 770 million barrels, and the well cost will be between $21 and $25 million, with contingency of a further $5 million, totaling $30 million.
Turning to page 8, a summary of the key features of the transaction. I would mention, for the benefit of shareholders, there is extensive documentation that is and will be available on our website, so shareholders are encouraged to read that closely. But effectively, what is happening is an all-share merger of BPC and Columbus. This will be effected by BPC acquiring 100% of the share capital of Columbus through a court-sanctioned scheme of arrangement process. We're very pleased that both boards of both companies have unanimously recommended this transaction as being in the best interests of shareholders, and we have received undertakings and letters of intent to vote in favour of the transaction from shareholders representing just under 20% of the Columbus share registry, which we regard as a great vote of confidence in what we are proposing. As noted on the slide, both BPC and Columbus shareholders will have an opportunity to consider and approve this transaction at separate meetings of shareholders. Those will be held in the second half of July. And the way it will work is that, subject to the transaction being approved by the shareholders in the court, the shares held in Columbus will be exchanged on the basis of an agreed exchange ratio, that is 0.803 BPC shares for each Columbus share held. And what that really means in effect is that once the merger is completed, the existing BPC shareholders will retain approximately 76% of the combined company and Columbus shareholders 24%. It's also worth mentioning that on closing, the BPC executive will remain in place, the Trinidad in-country management and team will remain in place, and the executive chairman of Columbus, Mr. Leo Coote, will be joining the Bahamas board as a non-executive director. So in terms of a timeline, shareholders can expect to receive documentation for the general meeting by the end of June. The meeting will be held in the second half of July, and then there will be a court hearing, and assuming all goes to plan, the transaction will close in the very start of August. And that brings us to the final slide in this presentation, where we've sought to lay out the vision. This transaction in merging Bahamas Petroleum with Columbus and then in securing a license in Uruguay marks the first step in what we believe is the delivery of a bold new vision for this company. As we've mentioned several times already, core to that vision is a balanced portfolio, multiple projects in multiple places, spanning production, near-term production, appraisal, development, and the same high-impact exploration that BPC has represented to date. It's important when you have a vision to have a clear and measurable growth trajectory, and we believe that this provides just that sort of growth trajectory, building to material levels of production, revenue, and profit, retaining the same high-impact exploration upside, and enabling us to leverage both organic growth and consolidation opportunities. We also believe that we as a team at BPC represent an efficient, cost-effective management team. We've all worked in multiple projects, multiple countries, at different companies around the world. And as part of our vision, we see a company that builds on that to develop an impeccable health, safety, and environment record, to be a respected and trusted regional operator. It can't be understated how important your license to operate is. You need to be respected and trusted by governments, by regulators, and by stakeholders. And equally, you need to be a place where people want to work, where talented people choose to come and practice their skills and gain their experience. And for all of that to happen, you need to be well-funded. And well-funded means having a strong balance sheet. It means having multiple capital sources. It means being attractive to institutional and longer-term providers of capital. And it means being in control of your capital allocation choices and to not be reliant on debt as a way of funding activity, as a primary means of funding activities. And all of this is what we would call our vision, the vision of creating a full-cycle Caribbean Atlantic margin-focused exploration and production champion.
So even before the current global pandemic and associated collapse of oil prices, as I stated at the beginning of this presentation, the international hydrocarbons industry was in a state of flux. Single pure-play exploration assets in frontier basins remain extremely exciting, but this excitement is matched by a higher risk profile. A portfolio approach offers many advantages where individual asset risks can be naturally offset against each other as they emerge. Such portfolio attributes might include a range of assets of varying maturity within the life cycle, diversity of geography, of jurisdiction, of play type, and control of investment timing, of the resources, of the deployment of people, skills, capital. The international hydrocarbons industry has many euphemisms or code words for the benefits of having a diverse portfolio of assets at different stages of maturity, such as the ability to fill the hopper or keeping the conveyor belt running. The benefit of being the ability to offset one outcome against the other, which affords a greater ability to stick to an overall aggregate plan of delivery and therefore enhancing shareholder returns over the longer term. The advantages of a portfolio strategy, scale, diversity, range and control are, in our view, in BPC's view, important ingredients to ensure a company survives and thrives in the changing industry landscape we see. A combination of BPC and Columbus greatly enhances the company's ability to deliver such outcomes with a greater level of assurance, which we believe will significantly improve the company's combined entities' access to capital, being more attractive to institutional and longer-term capital sources. All in all, we believe this combination will deliver superior shareholder value. Please pay attention to the contents of this slide concerning forward-looking statements and qualified person's statement. A10 and I thank you for your attention in viewing this presentation today, and we look forward to engaging with you all at the upcoming shareholder meeting and to your support for the proposed merger. Many thanks.